for lack of a better term, you could have 100 houses in Atlanta where I'm located, for instance, and those 100 houses are spread out. So you go fix one HVAC, and then you got to get in a truck and drive, and then you can fix another one, and it's very inefficient. In an apartment complex, you have between the types of properties we buy, you have between 100 and 300 of them, and they're all in the same place. You can just walk from unit to unit. So the operating efficiencies are off the charts. And then you include with that financing a single family home portfolio is very difficult, whereas financing a multifamily property is, I don't want to say easy, but as close to easy as you can get for that much money that they're lending.
This is episode number 03 of the Multifamily Success Stories podcast. Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
and Julian Sage,
and welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, deal makers? Julian Sage here, and in this episode, I had the special honor of speaking with Mr. Steve O'Brien, the co-founder and president of Arcan Capital. Arcan Capital is a privately held real estate company focused on the acquisition and management of apartment properties throughout the Southeast, Mid-Atlantic, and South Central United States. Arcan Capital has over $250 million of property under management and services 3,000 doors. In this episode, Steve shares his experience of his first job as a financial analyst to starting an investment fund with only 12 single-family homes, which eventually pivoted to apartment investing to where they now again have over 3,000 units. If you like my show notes for this episode, go to multifsuccess.com/EP03. Or if you like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, everybody, to another episode of Multifamily Success Stories podcast. In this episode, we have the special honor of speaking with Steve O'Brien from Arcan Capital. Arcan has over 3,000 properties under management or $250 million under asset. Steve, if you wouldn't mind introducing yourself to the Multifamily Success community and let them know who you are and what inspired you to get into multifamily investing.
Sure. Again, Steve O'Brien with Arcan Capital. We're a multifamily investor and operator in the southeastern United States. As you mentioned, we have about 3,000 units and currently 17 properties that we manage from Alabama all the way over to North Carolina. We got into the business in 2012, my business partner and I, and largely just because we think real estate is a great place to be. It's one of the very few assets that offers tax advantage cash flow with a chance to build and grow wealth. And in addition, we love multifamily and have always liked apartments because no matter what changes, and I think we're seeing some of this right now actually, is you got to have a place to put your head. And whether the opinions change of how much office space you need or retail preferences, you need a place to sleep. And that makes us feel very comfortable in the apartment space.
Now, you started Arcan Capital back in 2012, but can you take us back to when you first got into real estate investing and kind of how your journey has transitioned from when you first found out to where you co-founded Arcan?
Sure. I actually started in real estate as an analyst with CBRE, which I believe at the time it was the largest real estate services firm in the world. And it was a great place to be for a number of reasons, least of which is the volume of traffic, deal flow, all the way up to the caliber of people that are there, very smart people doing very large transactions. And in Atlanta, we got to see all of the biggest transactions in the time that I was there, the better part of a decade doing all sorts of underwriting. And I think in my time there, I underwrote over $1 billion worth of assets and actually had a chance to underwrite some big deals in New York City, like Chelsea Market and some great opportunities there that you just wouldn't be able to get at a lot of other firms. And what you learn there, I think, is extremely valuable from how to value the asset, to learn how other people, more successful people, how they value assets, how they run real estate, and how they view it. And it was a great education as much as it was a job. And at some point while I was there, I realized that I didn't want to be a broker. That was kind of the trajectory that I was on. I had to make a decision on whether I wanted to be a broker, or if I wanted to find a way to use the skills that I had attained there to do something else. And I always felt like when we were selling an asset or assisting someone put a loan on an asset or assisting someone raise equity for an asset, that the thing that I wanted to do was hang around longer and see how it worked. A lot of times brokers will come up with a plan or an idea and say, hey, buy this apartment complex and this is what you can do with it. You can put granite on the countertops and the stainless steel appliances in, and then you can push rents by X dollars. And that's great and it's fun. But basically every 3 months or every month, you're doing that again and you're creating a new story, but you're never actually executing on that story. And I always found myself wanting to call the people who bought it and figure out what was going on. And that's how I knew that I wanted to get on the principal side. Ultimately, I just had a great opportunity where a firm that was a registered investment advisor in the state of Georgia basically called me out of the blue and said, people that I knew before had said, hey, we're looking to buy real estate. Do you want to come build the platform here? And it was a great opportunity. I think I was in my late 20s at the time. So it was a great opportunity to come start from nothing and build a platform and have some control, some say over what we were going to build. And that was my way in the door. Is I built my credibility through the analysis and where I worked and use those skills and leverage them to move on and get somebody to, for lack of a better term, trust me with buying things and trust me with their money.
It sounds like you kind of went more of a traditional or collegiate route to maybe getting into the real estate space. I feel like a lot of people that are interested in multifamily investing, it's really maybe for the sole purpose of, kind of reaching that financial freedom, that financial independence. But you came into the space as like a college graduate, and then you found a job as an analyst.
Yes. I was a finance major in college. And so I initially out of school, I was an entrepreneur, I think, at heart. And so all these things kind of merged together. I started a few businesses out of school. Some went well, some did not. But I never lost the itch to start businesses. So I realized that, I spent a lot of money, or my parents did, or we both did, on getting a good financial education. I should probably use it. Because I think what I discovered as an entrepreneur was you're really the sales department. It's great to have an idea of, well, this is what I'm going to do. This is what my business does. But if you don't sell it and generate revenue, it doesn't matter what you want to do. You don't have a way to run your business. So what I found out being an entrepreneur at the age of 21 and 22 is that I was really a sales guy. And so that was a great skill to learn as I learned how to sell, which of course I use today too. But I decided to leverage that education, as you put it, to go I think it's a very traditional path. I know a lot of people that go that route. All right, I'm going to get my finance education. I'm going to become an expert in that part of whatever it is, even if it's investment banking or a different kind of business. And then I'm going to leverage that to get a job at a great firm. I'm going to learn everything I can at that great firm, and then I'm going to use it to make the jump, as they would say, to the principal side.
Can you kind of talk about those first entrepreneurial pursuits when you first got started into the space, and what made you kind of shift? You said it was that sales. You was very heavy on sales, but can you talk about some of those experiences with your first entrepreneurial journeys?
Sure. Yeah, they were really just ideas. One was a marketing business. Another was the credit card processing business. I actually still own a piece of the company that I started back in the credit card processing business. And, when you first talk about starting a marketing business, it was, we're going to market for people and we're going to advertise. And what you realize is, yeah, you're going to do that, but unless they pay you, you're not really actually doing a marketing business. You're just giving people free advertising. So what I had to spend most of my time doing was calling advertisers and saying, hey, this is what we're doing. this is what we'd like to do for you. This is how we think we can move your bottom line. And so those businesses were one was not really successful. The marketing business was not very successful, and the credit card business was very successful and ended up being a great business, which is why I'm still involved in it. I think my ultimate decision was, like I said before, you spend all this time going to high school, going to college, SATs, finance, and I wasn't using it. I was not the skill that I learned, I think, was very valuable, but I wasn't using any of my finance skills. And that was something that, professors and people along the way have always said, you're great with numbers. So I kind of sat back and said, I'm competing with a lot of other people that are great at sales, and I'd like to think I'm great at sales too. But nobody ever told me when I was 18, well, you're a great salesman, you should go sell stuff. So I tried to find something where I could put my skills together. And I thought that was to spend some time, revisiting my finance capabilities and building for lack of a better term, building a credibility of my capabilities, and then being able to leverage that at the right time. And that's exactly what happened. Having that plan and setting it out, I was just very lucky that it fell in the right spots, and the right person called me at the right time, and I took advantage of it. And I think that's how most stories go. I mean, you put a plan together, but you do it in pencil so that you can come back and say, all right, well, maybe I should do it this way now. And that's just what happened.
And when you finally got into the finance space, did you already kind of have a target of just real estate, or was it just anything that could come along and you just so happened to work for a big real estate developer? And also, can you explain who CBRE is for most now?
Sure. Yeah. So I'd always been interested in real estate since I was younger. It's just one of those things, and I don't want to say. It certainly wasn't like, when I was 10 years old, I told my mom I wanted to own apartments. That's not what it was, but it was always one of my interests. I was still way more interested in sports than I ever was real estate. Like a lot of kids were. I thought I was going to play in the NBA until I realized I wasn't very good at basketball. But it was always one of my interests. I tried to do it in college. I went to Emory, and at the time, Emory did not have an undergraduate class in the business school for real estate. So I kept asking if I could be in the MBA class, and they wouldn't let me take the MBA class as an undergraduate. So I really didn't get exposure to it other than friends and family and different people I knew that were in the industry. But it was always something that interests me. So when I had the chance after starting a couple businesses that, and one was successful, I had a chance to take a breath and sit back and say, all right, really, where do I want to take this at 24 years old? That's when I said, real estate is one of my interests, and just started picking up the phone and calling people and saying, hey, this is where the sales came in. Hey, I'm really smart. You got to hire me. I just don't know anything about real estate. And a lot of people laughed, and finally one said, this is a great boss. The guy that hired me into real estate. I met the guy. He said, perfect, because I just want someone smart, because I want to teach you real estate. I don't want somebody coming in thinking they know anything about it. I want to bring you in, and I want to teach you how to do real estate. And I just want someone with a brain. And that I got very lucky to find the right guy. But I think there's, that's why I was getting on the phone and calling those people was a big important step. And then I think you asked about CBRE. CBRE is, I would call them a brokerage firm, but they do a lot more than that. They have CBRE Investors has a fund, I think multiple funds where they invest for pension funds and advisors. So they're on the principal side too. I think they have, they do leasing, both tenant rep and landlord rep. And they also do, investment banking for real estate, where they will sell, refinance, or raise equity for deals. So they do a lot of everything over there. And that's why I said it's great to be there. You walk into a meeting and you've got people who've done $20 billion worth of transactions all sitting at the table talking about how to do this next transaction and how you should set it up. And that's really invaluable. And I would still say, even though you've got appraisers out there and you've got all sorts of different people whose job it is to value things, I don't think anybody knows the value of an asset better than a broker. They're the ones selling it, and they do it all day, every day. Doesn't mean that they're always right, but by and large, where they're selling these assets is what they're worth. And so it was a great experience to learn how to peg a value, because as an analyst, the first thing we did was we'd pull the real estate and we would underwrite it and figure out what we thought it was worth. And then your job was to go convince the market that that's what it was worth. And that was I think the most valuable tool I've got right now is I feel like if you hand me an apartment, I can tell you what it's worth. Um, well, up until the last few months, I could. Now I'm not sure I can.
Yeah, I think that that's super interesting how, how you were just cold calling people, and probably, I can hear from that experience that from your first business and having that entrepreneurial pursuit, you were just like, you weren't afraid to go out there and just start cold calling people and picking up the phone and saying, hey, hire me. I've got hustle. I'm willing to put in the work. But it sounds like you had, like you said, you were very lucky. You found a person that literally just said, I don't care about your experience. I just want someone that, has that drive, has that pursuit, has that baseline knowledge, having that finance background. Do you think that that's still the case? Do you think that you can still find analysts or get into a position with a firm without having any prior real estate experience, or not having like interned or like anything like that?
Yeah, you just got to be willing to start at the bottom. I mean, the nice part about doing that at 24 was I had no illusions that I was going to be a managing director when they hired me. I expected to be brought in as the lowest, which was analyst. There's analyst and senior analyst and, whatever, they kind of, you rise up as you go. And I didn't have any expectations other than I just wanted to get in there and learn. And that's what you get. You get paid. And actually, you get paid pretty well as an analyst. It was a while ago for me, and I'm sure they're paid a lot more than I was. But yeah, I think people say this a lot, and people are like, oh, that's not true. But it is true that a lot of your first jobs, you're really getting paid to learn if you pay attention and if you put in the work. And yeah, the 80-hour weeks are a lot. I mean, that's what that's what they expect. And this was before you were allowed to work at home. So a lot of times you were in the office at 7 and you didn't leave till 9, and you invariably had to do some work on Saturday. And I think that was a lot of people's experience, both as investment bankers and what we were trying to show, because they were trying, I think CBRE, and like other brokerage shops, they're trying to weed people out too. They're trying to see who can cut it. And if you can cut it, you can work these hours and learn all this stuff and do it, then the cream rises to the top, and you'll end up being a broker one day, or you'll get hired by a client, or go through the situation I did, find somebody who wants to use your skills in another way.
Is that the mindset of most people when they are as like an analyst? Are these people that are just looking for more like a W-2 job or just a standard job? Or are these people that are trying to prime themselves to be able to go out there and do these deals on themselves or create their own company like you did?
I think it's all over the board. I mean, I think every boss I had knew that I wasn't going to be an analyst for long, and I wasn't shy about it. It was a means to an end. And everybody has a different opinion. A lot of people that I know want somebody that's going to be the analyst and wants to be an analyst, and that's all they want to be, and they'll do it for 10 years. But I think, it's a great question. Would you rather have somebody that wants to be an analyst for 10 years and they're happy in that role? Or do you want to have, a potential superstar for 2 years that may be the best analyst there is, but you're going to have to replace them every 2 years because you can't keep them in that role. They're going to keep exceeding that role. And I think that's a question that we deal with. We have a lot of employees in our company, and you want the great people, but you find yourself sometimes in a trap where you're thinking, man, this person's great, and I just want them to stay here. But the best people almost never stay there. They almost always go to the next level, and you got to put something together that allows them to exceed and to move forward.
You mentioned your next step in progression from being an analyst, or the track that you were on was going to lead you to being a broker. Now, compensation for a broker is commission based, I believe, correct? What does that look like, or technically, how much money did you turn down by not wanting to be a broker?
Ultimately, I don't think I turned down any money, but in the near term, I probably turned down a lot. I think there's kind of a running between principals and brokers. There's sort of a running joke where all the brokers say they want to be principals, and all the principals say they should have been brokers, because one of the jokes that all the principals says, oh, there's the brokers are the ones making all the money. It's like, all the lawyers, they're the only ones making all the money. And I think, listen, everybody's doing pretty well if they're doing their job and they're successful. I think, especially with what's going on right now with the COVID-19 pandemic,
Right.
Transactions are falling off a cliff. I don't think anybody's excited about the broker pay, and I don't know the statistics yet, but I can guess what they're going to be, and I don't think anybody's going to be excited to be a broker between March 2020 and June 2020. I don't think anybody was happy about that. Now, I think there are obviously exceptions, but when transactions fall off a cliff, so do what happens with brokers. So I think I still, if I'd gone the brokerage route, they probably would have found a way to plug me into some deals. But the reality is coming off an analyst, it's not like I had a stockpile of clients that I could go to and say, hey, give me a bunch of business. I was just an analyst and now I'm ready. So you kind of need the right mentor, I believe, that will bring you along and start sharing some of the pie. And that was my experience about how it happened. And then there are another set of brokers that don't get in as analysts. They come right in as brokers, and from day one, it's commission, and you got to go build your book of business. I feel like tenant rep is very much that way. You show up and start cold calling tenants and get some tenants that want to use you to help expand or redo their lease and go get some leasing commissions. And I think that's how it works. But every shop is different. CB, I feel like may have been different because I felt like there was so much business and the company was growing so rapidly that they were looking to cultivate new talent and build teams. Sometimes a broker would leave or somebody would retire and you need to backfill with younger talent. So it just depends. I think it's really hard to answer that question, but I do think what I did was give up near-term compensation for, satisfaction or more compensation on the back end, which is, part of what investing is though. And that never really crossed my mind as a downside. Because almost all the investing, not only do you, the way that we invest, not only are you able to make money, but you're also kind of building a portfolio of assets, cash flowing assets as well. So you're doing both. And that's part of what we like about the investment side of real estate.
Can you explain the difference between, you threw out principal and broker. Can you explain the difference between the two and what made you kind of lean towards one path over the other?
Yeah, sure. So, brokers are really there to, I guess, facilitate the deal. I'm actually curious to hear what, your best brokers would say. Like, what do they do? There's what you do, and then there's what you really do, your mission. And I think most brokers would say that their mission and what they actually do is help facilitate transactions. They find a willing buyer, they find a willing seller, they get people to come back to the table when, sometimes they are yelling and screaming at each other and disagreeing, and one doesn't want this in the contract and the other does. They help value things that, I think so. Largely what a broker's doing is taking a little piece of every transaction, not dissimilar from a real estate, your local real estate agent, right? They convince you to sell their house and then they take a fee. And even at CBRE, at Jones Lang LaSalle, Cushman & Wakefield, I think that's how the model generally works, is when you help me procure a buyer and I'm going to give you a piece for making sure the transaction goes through. Whereas on the principal side, you're the one actually doing the transaction. You're the one investing the money, or at least representing the money. You're the one running the asset in theory, although obviously a lot of principals hire a property manager. We're vertically integrated, so we raise our own money or identify partners that can help us raise money. And we acquire the asset, we get the loan, often with the assistance of a broker, and we manage the property as well. But there are a lot of investors that all they do is the money. They buy it and they find someone to run the property. It can be done in a lot of different ways, but I think everybody, if you are part of the ownership entity, you would consider yourself a principal.
And choosing to go the principal route over the broker route, is that because there is more of an entrepreneurial pursuit with being involved in with a principal rather than as a broker? Maybe that's more like a job, would you say, or is that still pretty entrepreneurial in its nature?
I think principals are just better than brokers. That's what the principals like me say. We're just better. We're more fun. We're nicer, smarter. Better looking. I think brokers, even at CBRE, where technically you work for a Fortune 500 company, you're very entrepreneurial. You're building your own book of business. It's very rare, and I don't think you'd find anybody over there that would tell you most from the bottom to the most successful that would say, yeah, they just sort of plugged me in here and I started making a bunch of fees. I think they're very similar pursuits entrepreneurially. They're just different ways of making money. Like I said, one is very transaction focused, where it's, put a deal together, get it closed, get paid. Put a deal together, get it closed, get paid. And maybe the brokers would say that's an oversimplification. And I think from the principal side, and what attracted me to the principal side is the idea of really making an investment and cultivating that investment. And I think from the broker side, they're not really doing that from the investment standpoint, but their investment is in their clientele. They're identifying the client, they're cultivating the relationship, and then hopefully every time that client sells something, they're going to come back and do it with you. So I think it's very similar and very entrepreneurial pursuits both, but I think it's more of on the principal side, and what I do is more about the investing and being the actual money in the deal, if that makes sense, as opposed to representing the transaction.
I think when most people are interested in pursuing, multifamily investing, they're just thinking from the principal side. But what you're saying is, even as a broker, you can still be in the multifamily space and still build that. But a lot of people that they're getting into this space, it's because they also want to reach this level of, financial freedom, financial independence. They want to build a legacy. Do you think that even as a broker, like that's kind of the mindset and the goal, working for a company, like working for a Fortune 500 company, is your mindset still, reach financial freedom, have this type of independence, or is it more like a job where you're just kind of paycheck to paycheck?
I don't know. I think you probably have to ask. Well, and I should say, the reason I get to be mean about brokers is I actually am one. I'm the broker for our company, so I'm a broker and I'm also a principal. And so in a roundabout way, that's probably my answer. I know a lot of brokers that's what they do to make a living, but then they take their living and they invest it in deals, and so they do both. It's not the Venn diagram can cross over a lot. It's not mutually exclusive to be a broker or a principal. And in fact, there's nothing preventing me if I saw a deal and somebody came to me and said, Steve, I really wish somebody would buy this for me. I could serve as a broker if I wanted to. I'm licensed to do it. I could very easily say, hey, listen, I know a guy that'll buy it, pay me a fee, and I'm licensed to do that. So I think there's a lot of crossover, and it just depends on, I guess, where the lion's share of your money is made. But I have a lot of friends that run smaller brokerage shops that are not a Fortune 500 company like CBRE, and extremely entrepreneurial. And half of what they do is brokerage, and they make money transactionally, and half of what they do is invest that money into real estate. So, like I said, they can do both. I think typically at a place like CBRE, you would identify more as a broker. If that's what you were doing, you would say, this is who I am. I do the broker, and the investing stuff would kind of be more something on the side, or something you do out of retirement or for your retirement, not in retirement. But, I think those are very challenging, demanding, time consuming jobs that I think most of the folks there are there to, I sell apartments and that's all I do, or I sell retail centers and that's all I do, or I sell office buildings and that's what I do. And that doesn't mean that's all they really do, but as far as the company and their business profile is concerned, that's really where their focus is.
Can you kind of talk about you went through this transition from being an analyst to where you could become a broker, but then you decided to start Arcan Capital in 2012. Can you talk about that experience and what that was like? Did you feel like you were out of your element starting going into this principal space, or did you feel like it was a natural transition from analyst to principal?
Sure, and I think I should probably clarify. So when I left CBRE and had done, worked at other brokerage shops as well from that period before 2012. I actually started working at a registered investment advisor where we founded a company that was not Arcan Capital, and that's where I met my current partner at Arcan. There we started investing in real estate and built a portfolio there. And in 2016, we exited to form Arcan Capital. So kind of did it twice. And I think that's sort of the progression that we went through was, start start there and begin your process as a principal. And then we gradually transitioned to moving out and starting our own firm in 16.
And what was that like when you first started? Did it feel like it was an easy transition, or did it feel a little challenging to have to learn maybe new things?
Yeah, not easy. Well, maybe the transition was easy because it was something I was really excited about doing. But when we started, we had 12 single family homes, and that's it. We were like, okay, we want a real estate department. What are we going to do? And when I showed up, I said, well, what do you have so far? And they basically said, we've got a lot of clients that are interested in investing, and we have 12 houses. And going from there to 3,000 units and 100 and something homes, single family homes that we managed, realizing that we didn't like the single family home model, focusing solely on apartment investing. It's a long, difficult transition. And when we first started, we weren't even property managers. We made our first investment as just principals, as basically like an investment house, saying, hey, we're going to make an investment and we're going to let somebody else run it. And we quickly realized that, in our opinion, we could not affect enough change. We could not have enough control to do the things that we wanted to do and secure the investment without being a manager. So then we learned how to become a property manager, and that's how we vertically integrated. And now, we very much believe in that vertically integrated model, that if somebody's going to invest in real estate for you, we really like the model of being an operator, an owner, an investor. As we tell people today, if you invest money with us, it doesn't leave my site until the vendor's paid. It's us signing the checks. And that's powerful for an investor to know that, okay, I'm going to give this guy my money, and he's not just going to give it to somebody else and then they're going to watch it for me. He's watching it the entire time. And it's an added responsibility, but another layer that is added if you hire an additional property manager, that's not necessary. And I think the model is, I don't know that it's 50-50, but there are an enormous amount of groups that all they do is property management. There are an enormous amount of groups that all they do is investment, and there are a bunch of groups that do both. So it's worked all the different ways. I think just for us, it was a personal preference of the only way we can do this with value add apartments, where we're doing renovations and really trying to change the asset. We just couldn't figure out how to do it if we weren't managing it as well.
And for the investment group, you guys tend to focus on what types of properties? Are you building properties? Are you taking some older properties and renovating? How does that look as far as your portfolio goes?
We are predominantly a value add investor. So we do some kind of renovation work, but we would say that we don't do new construction, although we are looking at it now. And part of the reason we're doing that is because we've done such large projects that building a new deal doesn't scare us anymore. We've taken something down to the studs and started over, which some people may say is harder than building new. I don't know, but I do think that our focus is adding something to the investment that maybe somebody else didn't see. Whether that's what most people are doing right now, which is you go and you renovate the kitchen, and you spruce up the leasing office, and then you try and get more rent, and you try and create added value. That's a model that we've done a lot, but we've also done as little as, they're just not running the place correctly. It's a great property, but we can run it a little leaner, and maybe, it's just as simple as a couple of small tweaks that end up increasing cash flow by 10%. So we will do a very minimal value add up to a huge value add, which could be replace almost everything.
And with your initial team, so you said that you started off with just some single family homes, and then you eventually scaled to, being the jack of all trades. What was that like when you were put into this new position and trying to build out your team to be able to handle these new types of endeavors? What was the first thing that you felt like you had to tackle in order to be able to pivot the business away from just single family?
Well, I think the first key was you couldn't alienate the investors that had gone down the single family road, because investment markets change. At the time we were buying single family in 2012 and 13 and 14, we thought it was awesome. Houses were very inexpensive, and you could rent them out at very good rates and create a lot of value. But once the market recovered, we started looking around and just saying, the returns aren't here on the single family, and managing it is a nightmare. So, I think you go look at some of the other firms, there are a lot of big hedge funds that seem to have figured out how to do it, but I guess we weren't smart enough. I mean, it was very difficult. Whereas with apartments, when you build your management platform, you have, for lack of a better term, you could have 100 houses in Atlanta where I'm located, for instance, and those 100 houses are spread out. So you go fix one HVAC, and then you got to get in a truck and drive, and then you can fix another one. And it's very inefficient. In an apartment complex, you have between the types of properties we buy, you have between 100 and 300 of them, and they're all in the same place. You can just walk from unit to unit. So the operating efficiencies are off the charts. And then you include with that financing a single family home portfolio is very difficult, whereas financing a multifamily property is, I don't want to say easy, but as close to easy as you can get for that much money that they're lending. Which, by the way, if you use the agencies, is non-recourse. So there are a lot, in our opinion, a lot of very compelling reasons to switch to multifamily, and to focus that. I think for us, there were very compelling reasons to do that. And so as we started to do it, it really wasn't a full, turning of the boat. It was just, hey, we're going to keep doing this, but we're going to focus our energy going forward on this effort, because we think there's more return there, which I think is smart for any investor. I think about people in the hotel space and the retail space today, given what's going on. If you're in the retail space today with what Amazon and online delivery and everything has done, you are probably thinking very hard about where that market is going and how you're going to stay in it to be effective. Because I think everyone will agree that not that brick and mortar retail is going away, but that it's changing. The coronavirus, I think it's going to change the way that people go to the office. Everybody's already figured out that you can do this from home. And I think some people probably figured out that you can't, and I can't do my business from home for X reason or Y reason. But I think there are a large group of people right now in the office space that are nervous that a lot of these firms that have huge office space are going to say, I need half my space. I don't need this much space anymore. I'm going to have half my people work from home, or I'm going to do what they've forced us to do, which is I'm going to have this group comes in this week and then they're staying home a week, and then this group comes in, and balance it out. And they can save. I mean, rent is enormously expensive. I mean, we've got an office building too. Rent's one of our largest expenses every month. So I think there's some stuff out there that you're constantly evolving, you're constantly changing. I have no idea what the pandemic is going to do to co-working like we work. I mean, I imagine it's going to be a disaster. It's hard to social distance when the whole point of it is to be together. So I think things are always changing, and I think we've been both lucky and I hope it will stay that way, where we feel like a lot of these trends are moving in the direction in favor of apartments. And we do a lot of suburban apartments, and we feel even better about that. The idea that a lot of these cities were ground zero for some of this, and we really like a lot of these suburbs. And we're thinking maybe some people who can't afford houses necessarily or don't want to live in a house would like to live in suburban apartments, which in theory would make them a better investment moving forward too. So I think you're always evaluating where you think things are going, and that's part of what's fun about being the investor, is you got to put your flag in the ground somewhere and say, I think this is going to work, and it's going to make money, and this is why. And sometimes you're right, and sometimes you're wrong.
Can you talk about your first deal with your new team with Arcan, what that was like, acquiring that first unit and then getting into the management?
Sure. Yeah. The first thing we acquired, and I'll actually go back because it's a better story. The first thing we acquired at the prior firm with my business partner was at Arcan in 2012, was a property that was basically about to fall over. And when we took the team to go see this property, we had this grand vision for what we could turn it into. But you got to remember, the world was a different place. In 2012, people were scared of real estate because of what had just happened in 8, 9, 10. And this place was not in good shape. It was in bad shape. So when we come through and my partner and I are walking through saying, you got to see this, you got to envision this and envision that. And the other half of the guys that are with us are thinking we're out of our minds and we got to get back in the car and get out of here because we're going to get chased down the street and robbed. When the reality is all the place needed was some love and to be taken care of. And it was actually is probably still the investment by which all other investments are measured, which is easy. When you're buying things in late 12 and early 2013, you didn't have to be that good at it to make a lot of money. I mean, I love to tell you we were geniuses and that's why we made a fortune on that one. But the reality was I should have bought everything I could find in 2012 and 13, and it wouldn't matter what it was. I would have made money. It wouldn't matter how I ran it, whether I was good at it or bad. But if you put your flag in the ground and bought a bunch of multifamily in 2012 and 13, there's almost nothing you could do to lose money. So between that and the value we were able to create and the change we were able to make on the property, I think that property today is worth 3 to 4 times what we paid for it. That does not include significant amount of capital that had to be put in it, but it's probably worth 3 times, 2.5, 3 times the total capital outlay of that property. And I think that's an example of what we're looking for. That's the dream scenario. That's the one that everything will be compared to. That's very rare. But it does happen. And that was our first one. That was a great success. And by that point we had planned to do the property management, I think, because for us, we felt like we were in the dark if we weren't managing the property. And it's a challenge. You have to hire, that's where you start really talking about hiring employees. Today Arcan has almost 100 employees and they're located across 4 states. And even the 4 states, it's not like there's a central office. You have 4 people here and 6 people here and 8 people here and 4 people there. And it's very, very hard to manage both the people and the properties. And it's very, very hard it's really hard to build a culture when you can't have everybody in the same spot. So it's a big job to run the properties the right way, make sure everybody's doing things the same way that you want them to do them, because uniformity is key. Making sure that everybody's charging rent the same way. But then, of course, there are certain things that are allowed in North Carolina that are not allowed in Georgia. So those are the main challenges: is being aware of the rules, being aware of what your people are doing, and making sure that they're treating people the right way. And that's because that's the key. Not just investors, but we actually just believe, is one of the things we like about real estate, is if you're treating your tenants the right way, that's the best way to treat your investors, because there are a lot of people that don't do that all the time, and sometimes we don't as well as we want to. But that's the real goal, is to treat people the right way, provide the service as best you can, give them their money's worth, and ultimately that will make the property as valuable as you can.
What's been your biggest real estate failure throughout your time investing, and what have you learned from it?
That's easy. We've done 29 deals and only one has lost money. And the one that lost money was brutal. And it actually is really simple. You got to understand what you're buying. And from this instance, we understood everything about what we were buying except physically. This property had a major, major plumbing problem that was not uncovered by us or any of our engineers during our diligence. And we blew through our budget. And by the time we felt like we had it figured out, it was too late. We'd done all this work, replaced windows, siding, everything, and the property looked great. And that's what was so frustrating, is people would come by and say, "Oh my gosh, this place looks amazing," but they didn't know what was underneath. And plumbing and electrical are 2 of those problems that, in our opinion, it's both very expensive and almost impossible to run a property if there's a major problem with them. People will not stand for water and sewage leaking in their units, and they will not stand to not have electricity. They can't do it. And I understand that. And so you are forced into making those changes and forced into spending that money. And it's not easy always to figure out when, like you said, when you're surprised by it, you're just, why do we keep having all these problems? And then a year later, you realize, gosh, we really have to dig into this because it's not going away. Because a lot of properties, you'll do it. It's just as simple as deferred maintenance. And after a year of spending the money and staying on top of the issues, they go away. But that was not the case. And there were some underlying issues, and we had to spend an enormous amount of money to try and fix them. And right about the time we felt like, all right, we're starting to get ahead of this, our back was against the wall, and it was too late. And we needed to have a capital event. And we lost about, 15% of our investment. And it was very, very painful, but, it did give us something else that you add to the checklist. And, and our hope is, 28 for 29 and still returning, 85% of our investment, it still gives us a really strong track record. And we actually like to talk about our failures because I think it makes us more authentic. I think it makes you feel like, I don't know, it's the same thing. I invest outside of apartments too. And when I do, and somebody says, "Oh, I've never lost a nickel. I'm perfect. I only make money." It's sometimes you wonder. So, it's, we chalk it up to experience and learn from it. And that's one of the things we pay very close attention to now moving forward.
Do you still happen to own that asset currently?
We do not. We sold that asset, and that's how we kind of recognize that loss, if you will.
How do you come back from that type of situation with your investors? They're putting all this money into you and they're expecting a certain return, and they're going off of your experience, but then this type of situation happens. How do you handle or reconcile that type of situation?
We chose to just be honest. Communication from the beginning. We do quarterly reports. So if you've been reading and following our quarterly reports on that asset, you were aware that we were having an issue. And, because we disclosed it, we talked about it and what we were trying to do to fix it. And I think the main answer to your question is sometimes you can't come back. If you've got an investor and their only experience with you is losing money, they're probably not going to give you any more money. But luckily, like I said, that's why track record is so important. We'd done so well and made people so much money up to that point that, it runs the gamut. Some of our investors said, "Hey, go get them next time." And you're just like, what a great response. And that feels really good. And you can tell other investors are very disappointed and very, very frustrated. So it's everybody's a little bit different. And you just hope that your disclosure and your honesty and gets across to people that it was a legitimate, bad investment, not an accidental bad investment. And we see plenty of accidental, bad investments where somebody lost money or they bought something they shouldn't have and they weren't aware of a problem and they weren't paying attention. Then all of a sudden, got caught between a rock and a hard place. And I think that's why we try to communicate and disclose and tell people what's going on the property, good, bad, or otherwise.
In those types of situations, because you are acquiring these units and you're also managing them, with that unit, for example, could you have held on to that and, actually profited from it, because you had the management? Or how do you justify, like, when should you hold on to something, when should you sell it, when you're kind of doing them all?
That's a great question. We would not have profited from it because as soon as we realized there was a problem, we stopped collecting property management and asset management fees. So our opinion was, if you're not making money, we're not making money. And we probably couldn't do that all the time, nor would we all the time. But this was an instance where we just felt like it was the right thing to do to eliminate that, exactly what you brought up, which I think is a big conflict of interest. Is, okay, so my investors are losing money, but I'm making property management fees and I'm making this fee and I'm making that fee and it's great. And we didn't even want the perception of that being the case. So we chose to defer all of our fees. And, I think I can say comfortably that our company took the biggest hit on that property of anybody. And I like that. That's one of the things that I think in this industry, that's a real problem. Is there are a lot of investors that are investing other people's money and they're paid to get the money out the door. And that's totally reasonable, but it doesn't really create an incentive for them to prevent a bad buy. If you're incentivizing somebody only to buy things and get money out the door, they may not do their best job at finding the best assets. And so I don't want to say we were happy to do that for our investors, but I think we were proud to do it for them and show that we were willing to take the biggest hit, percentage wise, and just say, listen, like I said, if you're not making money, then we're not making money.
How is Arcane looking for investors, and are they open to sophisticated investors or only the accredited investors?
Yeah, I think that situation depends. I'm going to leave that one up to the lawyers. I think definitely, accredited investors is what we focus on. But I think, depending on the situation and how it's disclosed, I think, all investors, quote unquote, are welcome. But I do think that there is an accredited nature to this type of investment that is that is important to make sure that you're checking the boxes there. So by and large, I think that there are some SEC regulations that would require someone to be accredited, but depending on the structure of the investment. So I'll leave it at that. But that is generally, we are looking for investors of all types. I think we've done a lot of investments with larger JV partners that have come up and done 90% of the equity when we've done about 10% between the principals of Arcan and friends and family. We've also done investments for large family offices where we are not investing any money. They basically come to us and said, we want you for your real estate expertise. We will pay you, but we don't want you to invest with us. We want to have full control of the asset. All the way to just doing entire deals with friends and family investors. And we're actually in the process of raising a fund, that we can, is an accredited investor fund. So we do it in all different ways.
We're right in the middle of COVID-19, and a bunch of things are kind of up in the air as far as lending and like mortgages and stuff. Is your business going to be affected by any of that as an exit possibly?
Yeah, I think everybody's business is going to be affected by this. I'm guessing a little bit here, or I'm projecting. And I think that the government has stepped up with so much cash that we probably haven't felt it yet. Case in point, through April and May, our collections are very good, shockingly good, compared to what you would expect. If somebody came to me and said, you collected this percentage in your portfolio in April and you collected this percentage in May, all I would say is, that's not great. But if you told me what was going on today with the pandemic, I would be shocked by how much we've collected. And I think that that's great. We're very excited about that. But I also think it's probably reflective of the work that's been done in the federal government to fund and assist people. And at some point, that's going to run out. And I think the real question is what happens when that runs out, and what happens to the economy? How quickly can we get back to work? How quickly can people get their jobs back that have furloughed, fired, come back? And what's the unemployment rate is staggering right now, but it's not a real rate. This isn't what it really is. It's what it's forced to be. And so I think the real question is what's the rest of the year going to look like? And what we've been saying to a lot of folks is we're not worried about June. We're worried about October. And that doesn't, I'm not sure October is going to be bad, but we're confident that with April and May and June, I think it's going to be fine. And I think the question now is more about the larger economy. How is the larger economy long-term going to be affected by what we've been through? And, when the government stimulus runs out, how affected are people going to be? And was this the perfect bridge that gets everybody back to work and earning money so we can get going again? Or was it just a stopgap measure that everybody was worried about April, and instead July is going to be a disaster? But what is nice is we'll get a chance to bounce back. I think GDP projections are at or around 40% drop in the second quarter. And the good news is it will be a very short recession, because if you're falling 40%, you're probably going to grow in the third quarter. It's probably not going to get much worse than it was in the second quarter. So at least we'll be coming back, but we could be in expansion for years and not get back to where we were, and still technically be in an expansion because of how far and how fast it fell. So I think we're just waiting to see where it goes from here. We're being very patient. We're starting to see some deals come back. We're starting to see some money come back. It basically shut down for March, April, and May. And there were some transactions, but I think a lot of those were either very distressed, where people said, oh man, this is a great deal, I'm going to come in and get this, or they were already in the pipeline to be closed. And I do not know of many deals at all that I'm aware of that were started in March and completed, started after the coronavirus pandemic and closed. I know of many that closed anyway, or that were put together, in a very distressed situation that had to have a transaction, but I don't know many that you would consider true market. I'm looking for a deal. You brought me a deal and I closed at a market price. It'll be interesting to see, because I think that's starting to come back, because everybody's looking at the numbers and saying, hey, things are going well. Our properties are performing very well right now. And for the most part, we're not allowed to charge late fees or eviction fees. and there's a moratorium on evictions. So if properties are doing well now, imagine when we have the ability to evict non-payers, and collect late fees like we're supposed to. So I think the answer is we'll see. And I think ultimately long term, we're very bullish on multifamily, but that doesn't mean there may not be some short term distress.
Do you think that we're going to be able to ever see that point again where, like you said, back in 2012, where you could pick up any type of property and, make money? Do you think that we're going to be seeing that, post COVID-19 recession, or do you think it's going to be a different market?
I don't think broadly you will see that. Meaning, I feel like in 12 or 13, like I said, you could close your eyes and throw a dart at any property available and you would have made a lot of money. And I don't think that we'll see that. I think there will be selective distress on a property by property basis. But I do not know, especially with where interest rates are, that, by and large, one of the bad things that happened in the last recession was certain assets were just not financeable anymore, even in the multifamily space, because values fell so far. And interest rates, you just couldn't refinance them. So with interest rates where they are today, things were so healthy, and we haven't seen the massive drop in rent yet. I think there's going to be some time to refinance things and get them in order, but there will, I think, be selective distress where you'll be able to buy some stuff at 50 cents on the dollar, but you won't just be able to go down the street and pick and choose. And I think our portfolio is a great example of that, because we have a lot of really well-performing assets that if somebody came and said, hey, sell this at a discount, we'd say, get out of here. Why would we do that? It's doing just as well now as it was before, and we're not feeling any pressure. And so as long as there are no capital events like loan maturities or covenants that were broken, and that's part of what happened in the last recession that I don't know enough about the current state of financing, know that we're going to see. It doesn't look as though that will happen, but there were a lot of transactions that had to occur last time around where, between the CMBS market collapsing and a number of other items, that there were some forced capital events that resulted in transactions. And I don't know that we're going to see that same level. I think if you're looking for that kind of distress, hotel and retail are probably the ones that are going to get, that's where that opportunity is. Broadly, I don't know, but I think broadly hotel occupancies are way down and they're very much struggling. And I think retail's the same story. And it will just depend, because there is some sort of a domino effect that not every landlord and every lender has the ability to say, yeah, you don't need to pay your mortgage or you don't need to pay your rent. A lot of them can do that and wait, and hopefully they'll get back on their feet and they can absorb that, but a lot of them may not be able to. And this, same is true for, those retail, and a lot of restaurants are going to open back up and a lot will not. They couldn't make it through 3 months or 2 months or however long it is of not doing any business. They just can't make it. So I think we'll see as that shakes out, but I think there's a lot of uncertainty about the second half of the year.
And I hear the family in the background. And I know that we're coming to a close here, but last question that I love being able to ask is, what would you do differently if you had to start from scratch?
I probably would have been more aggressive than we were. Not just in every metric, not just in buying, but I would have trusted the process a little bit more, and I would have done a few more deals. I think we were very risk averse, and that's great. Like I said, it served us very well in our track record. I mean, being, of doing 29 deals and having 28 described as successful, we're very proud of that. But I do think, going back and looking at hindsight being 2020, we were joking about how, in fact, our investment committee used to joke that every property I saw, I wanted to buy, and we'd have lunch and they'd make fun of me. Oh, you've never met an apartment you didn't want to buy. And we joke. And I was like, yeah, I'm sure you guys feel that way because you don't see all the ones I turned down. But the reality is I shouldn't have turned any of them down. We should have bought everything we could find in 13 and 14. And I think what I would say is, to stick to your principles, and everything felt so inexpensive then, and everything underwrote well. And I go back and look at some of my underwriting and I just roll my eyes at like, yeah, this one wasn't juicy enough. And it was just, the pricing was just amazingly low. And so I think I wish we'd probably been a little more aggressive there, but, I think we're more worried about doing that going forward. And of course now, we're telling ourselves to be more conservative than we've been in the past because of how uncertain it is. So I may look back in 10 years and say the same thing. Oh, we should have been more aggressive then too. But I think, with the run up in pricing and how much capital's there, I think the conservative attitude is what we're going to take and use. So it's hard to look back and say that, but in retrospect, hindsight being 2020, it's really easy to do that and say, I just should have bought everything.
Great. Well, thank you so much, Steve. And what's the best way that if anybody wanted to be able to reach out to you or find out more about Arcan Capital, where can they go?
Sure. They should go to our website, which is www.arcancapital.com. And that's ARCANCAPITAL.com.
Awesome. And we'll include that in the show notes. Thank you so much, Steve, for taking the time and sharing your story. Looking forward to where you're going to be growing after this whole pandemic.
Great. Thanks, guys. I appreciate the time.
All right. Take care, Steve.
Bye.
Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.